Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by HardMoneyMastermind.com.
Welcome back to the Private Lenders Podcast. Today we are talking about private lending through infinite banking. And I invited on an expert named Russ Morgan onto the show. I'm going to introduce Russ here in a second, but about 4 years ago, I was introduced to the infinite banking concept and investing in mutual company whole life insurance policies to create my own banking system. Honestly, I feel like I studied the crap out of it for the last 4 years, and I still am not 100% sure if it's better or worse to use it along with private lending, which is one of the reasons I wanted to bring Russ here on today. Because he is certainly an expert at this topic, and it's a very interesting topic to say the least. So what Russ and I decided is we're going to kind of keep this 101 here at the beginning, just for learning purposes. This might be a new concept to you, maybe it's not a new concept to you, but I know that all of our audience members and listeners and watchers, they're savvy, they're private lenders, they're currently out there doing deals. So we do want to keep this a little bit higher level than 101, but I think we're going to go through kind of how infinite banking works first. And we're going to do a case study at the end to see if it makes sense. If you are a capital investor investing in private notes, should you just do it with cash, or should you hop in with some sort of infinite banking whole life insurance policy and go with that? So first and foremost, Russ, thanks so much for joining me here today, and maybe just do a quick background of who you are.
Yeah, man. Thank you so much for having me on. And I love the idea of us being able to share case studies and talk through it, because ultimately that's where the rubber hits the road. And it's when you're playing with it too. So my background, I was a certified financial planner for many years. The market crashed. I met Nelson Nash, who is the author of the book called Becoming Your Own Banker, at an event down in Orlando, Florida. And he was telling 400 or 500 other CPAs, CFAs, CFPs, and all the other acronyms in the financial space about this idea of becoming your own banker using the infinite banking concept. And I thought it was a trash idea initially, because they were talking about using whole life insurance. And my background up to that point was an investment advisor, and nobody with any credibility at that point would have been saying use whole life insurance, in my opinion. And it was because I had no experience. So it wasn't until I started actually digging deeper, the further I went down the rabbit hole. And it took me a while, by the way. I think I had to unlearn way more of that garbage I had in my mind. I realized this was such a huge fit. And so that was 2009 when I met him. So this has been 16 years of me personally practicing this. And, I love to tell people, look, I don't want to be a thought leader on anything. And I love the way that you and your partner, Chris, you talk about all the deals you're doing. I know you guys have done like 4,000 hard money loans and stuff like that. My business partner and I have been using this strategy at a pretty high level. We report every single month on our personal passive income, and we've built up over 50,000 a month. And it's only as a result of us using this exact system. There's no way in the world I would be at that level had I not had it. So glad to break down as much of this as possible and hopefully point people toward resources that they can keep learning more.
So the basics of the strategy in essence is, so full disclosure, I have a policy that was set up 4 years ago. It wasn't with Russ. I've only met Russ recently, but it's through Penn Mutual, and it follows infinite banking concept. I set it up 4 years ago, and I put in $50,000 a year, and it's in a whole life mutual company. I guess that's the best way to say it, through Penn Mutual. And I guess the setup isn't, tell me if I'm wrong, but you put money into that policy first, and in order for it to get liquid, I take policy loans against it, and then I use those policy loans to invest in private notes.
Yeah, no. So what you're breaking down, you said a couple of words I want to make sure the audience understands. One, mutual company. There's two distinct companies in the insurance world. A mutual company like Penn Mutual, Mass Mutual, those are some of the big names people would recognize. 4 or 5 other companies that we use as well that are good for this concept. And then there's stock companies, names that you may recognize like AIG, right? Like that was a big name that people knew, Prudential, right? These are big names that you see out there. The difference is that the dividends, the profits of the company for a stock goes to stockholders, people who invest in the stock that's traded on the exchanges. Mutual companies, the profits goes to the policy holders. So we use only mutual companies because we want to participate. We want to be the ones receiving those dividends as compared to stockholders.
Yeah, makes a lot of sense, and that's the right strategy, right? The goal isn't necessarily just to use that whole life policy as an asset, especially since you have, or an asset account, especially since we're all active investors and we can figure out ways to invest in quote unquote deals. But as a private lender, the goal is, hey, put the money in there, get it liquid, get that thing working for you at 10%, 12%, 13, 15, 20%, whatever you can lend it out at. And I think that's kind of where the magic happens at, hoping Russ will be able to explain to us here today.
Yeah. So the key is that, why do I want to do this, right? Like up to this point, where have you been storing cash in the past? Most likely it's been in a checking account, right? That's what most of us do, either in our personal accounts or in our business, some sort of retained earnings. We have checking savings accounts where the majority of all our cash gets stuck. If we're investors, maybe we're putting it in some sort of money market account or something like that within the investment accounts that we're working out of. So for us, we're just trying to say, hey, where's our cash going to reside? Because we don't use all our cash. I don't know about you. I've done tons and tons of studies on this, and looking at the average investor, they have, anywhere between 20 and 50% of their cash always sitting idle at some point, right? They're looking for deals, they're doing deals. But if you took a global look across all their stuff, they got money sitting idle at lots of times. And this may be because the deal flow is not as readily available as they want it to, or they're trying to hold back for something that's coming up. And so one of the things I tell people is that when we're thinking about our cash, we have to have a better place for it to reside. Anytime cash sits in a checking account, it is losing money. As we know, inflation, we got, 10 million, chickens that just got killed off, right? Like the price of eggs, chickens, everything's going up. We've got the gas pump constantly, like a risk of us, not being able to afford a gallon of gas. We've got to keep our money working hard. So at the base level, an insurance company is going to put your money to work at loans, and they're going to pay you return on it. These insurance policies that we use, Jason, I've had an insurance policy since 2009. I have a system. So I have a lot of insurance policies. I won't maybe necessarily go through it. So I roll back the eyes of everybody listening, but I've been using this, and the average rate of return I'm anticipating on this after tax is between 3.5% to probably 5%, where that is money that I can use. And the beauty is it's not taxable. So as we think about, as we're going to take and put money to work, like you said, I want to find deals where I can borrow against this money and put it to work at 10, 12, 15% returns or better. And if I can do that, now I get the return of that asset, plus I get the safety of a place to come back and put it that's greater than my checking account.
Yeah. And the way that the current one that I have set up is, I'm not exactly sure what my annualized return is, but like you said, 3 to 5% or 3, 4%, 5% or whatever. And then, like, for instance, I just put in money in January because that was my renewal date. And, I took the money right back out as a policy loan, and my interest rate on that's 5.2%. So it's a little bit higher or similar. Do you want to go through your presentation?
Yeah, I think that'd be great.
So if you're listening to this on iTunes or wherever, Spotify, make sure to just go over to YouTube, Hard Money Mastermind, and you'll be able to access this here. I'm going to bring this on the screen. But again, even if you're listening to this on audio, you'll be able to catch it all. But there's definitely some visual representations that I think will be helpful.
Yeah, no. We coined the phrase the passive income operating system, and it is really, how do we turn active income into passive income? So I know you have a lot of listeners that are actively making a lot of money, and they're trying to figure out how to put that active income to work so that they can build up passive income streams. And you have a ton of passive income investors that listen to the show. And the key is that if we can figure out a system, so we built a whole process around a system that includes infinite banking. So infinite banking is like the engine, but ultimately it's the mechanics of what we're doing internally that make this work on autopilot. So if you're interested in that, like for us, there's 3 components. There's the organizing cash flow, which helps us get money out of places, redirect money that are, being put in places we can't access, can't use it, can't get it into deals and do loans. The second component is, how do we store it, right? The reason why we use infinite banking, because that is the best storage place I have found for my cash, not for my investments, but for my cash. And then the last component is, how do we automate it so it doesn't stop? So as you're listening, if you don't have access to the QR code here, go to what'swhatwallstreet.com/private lenders. And there's a free resource that actually gives you this ebook. And we have all sort of free things along with that. So just a tool that you could use no matter what that you gain from this. So I want to talk about obviously the storage place, which is the part where we're putting it into infinite banking. So that kind of falls into three components, Jason. Redirecting cash so that we can actually be able to get it to work in the places we want to. Leverage, which, I mean, you're a lender, right? You understand leverage at the highest level. And when you really start doing leverage, you start borrowing other people's money in order to do private lending, right? And then three is recycle it. How do we make it happen over and over again? Every business operates with some form of recycle, right? Their inventory varies. Well, your inventory is cash, right? You're doing loans to people, just like a bank would. So the redirect part is, how do I get it in a place I can use it? So one of the mistakes this is just kind of one of the simple lessons, me looking at hundreds and hundreds of financial statements for people, is most of the mistakes people make is they use one account to operate everything out of. And I'm sure in your group, nobody's making this mistake, but not everybody listening, unfortunately, is in your group. So this is one of those kind of like upgrade hacks that you can have, is if you're trying to do your investing and your savings and your spending all out of one account, stop that immediately. Like, you will make more money, but you will spend way, way, way more money, and you'll just stay on that rat race. So for us, like, how do we help people get out of that? So it's redirecting. So people ask me, and this is going to be a question that's going to come up, Jason, you're going to say, how much money should people be putting into the system? How do I even know how much to put in it? And at the base level, this is how I answer it for you. You know how much you're spending every single month in your personal life, and it's got to be less than what you're making. Well, whatever that extra amount is, whether that's $1,000 a month, whether it's $100,000 a month, that money is what I send over to the right side. That's what I use to start off my system. Is that clear? Any questions on that? So that's the first thing people ask. Where do I do it? Now, if I get it over there, now I can start doing deals with it. I'm going to tell you the big traps that people have is they put it in places they can't touch it, that they can't lend it out of. And I know some of you are doing private money loans out of your SEP IRA and your self-directed IRAs, and you're feeling good about it. Unfortunately, that's a trap, right? Because if you need it to start living off of, the government's still going to give you all the restrictions. So while you can use it, they've given some opportunity for you to lend it. They haven't given you an opportunity to take it. So one of the things we talk about is, like, our money should be our money. And we pay penalties immediately to get access to money. And so I would say, if your money's trapped, whether it's in IRAs, 401ks, markets, even equity, which is good things, that's still money that you can't use today. So we want to help people redirect and think about redirecting that money. And then lastly, I said this already, is that cash is one of the most expensive assets you own. Even if you're getting a return, it's probably minimal and it's taxable. So the upgrade, as you were kind of already stealing my thunder, was that you use this concept called becoming your own banker. It's not a new idea. I've been talking about this for 15 years, sharing this concept over. So let me break it down for everybody listening. And if you're visualizing this, how does it work? So I go to an insurance company. Jason, you said Penn Mutual. I have insurance policies with Penn Mutual. I have insurance policies with 6 different companies. So I'm not partial just to Penn Mutual, but I like them. They're one of the old, I think they're the second oldest mutual company out there. Why do I use any whole life company? Is that I'm going to put money in cash value, and that money is going to be liquid. It's going to be protected. Protected from what, Russ? Protected from loss. The cash value is guaranteed to grow no matter what. It has to contractually grow to equal the death benefit in the future. So if you think about it, you go to an insurance company, you put money in it, they're going to give you a death benefit. And for simple oversimplification, let's say the death benefit was $1 million. I just said that contractually, your cash value has to grow to equal your death benefit. So in the future, your cash value must be at least $1 million, true?
Yep.
Otherwise, that would not be a contractual guarantee. It's also protected from creditors. So when we're in business, we're in life, we're subject to people suing us, right? And if someone can sue you, whether it's at your lake house because somebody ran into your dock, or it's because your spouse was driving the car, ran into the back of them, or they fell on your in your rental property, whatever it is, if they can come access dollars that you have, then it's not really yours. And a lot of the accounts that we own are not really well protected. life insurance are granted some of the greatest creditor protections out there. Every state's a little bit different. There's only a handful of states that really allow for people to even have access towards some of it. But in my state of Alabama, 100% of my cash value is creditor protected. And the last component, which I think is super important, especially when we start trying to build wealth, the greatest obstacle to us building wealth is going to be how much of it do we get to keep? And we're in a day and age where the IRS is definitely getting in our pocketbooks more than we want them to. So it needs to be tax efficient. So this is the key reasons. Why do I use whole life insurance policies? Because it's liquid, it's protected, and it's tax efficient. Now, we already kind of said it's going to earn somewhere between that 3 to 5%. People always say, man, I thought this was a really bad investment. I thought it was too. But it wasn't until my business partner, who used to work at Wells Fargo, learned this simple concept that the banks are the largest investors in life insurance. I think you already knew that, right, Jason? You probably saw this stat, but I don't know if you saw this. This is actually, if you're looking at this online, this is a balance sheet from Wells Fargo from, I think, 2021. And their real estate assets, this is all the bank premises that they have, at the time was a little over $11 billion. And we all know that the three keys to real estate is location, 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 and banks have the greatest locations in the world. All of those real estate assets for Wells Fargo were $11 billion. But if you scroll down to line 41, you see life insurance assets, Jason. How much money and cash value life insurance did Wells Fargo have in the same year?
19 billion.
Does that shock you that almost 80% more cash value than they have in all the real estate assets?
Yeah, follow the smartest people in the room.
Hey, so just at a baseline, I mean, I know there's a ton of people that are listening to this that have either A, never heard of this, or B, have heard it and haven't done anything with it. That right now is one of the things that had to unlock for me when I was like, okay, I don't understand all there is to know about this. And by the way, I've been doing it for 15 years. I still feel like I'm learning. I think that's why Nelson Nash named it Infinite. But when I saw this, I thought, okay, does Wells Fargo have a handful of people that are maybe a little smarter than I am when it comes to finances? Banks obviously doing private lending at the highest level. And they've got $19 billion, almost twice what they have in fixed real estate assets in this. Is this something that I probably should lean into, that I should start to learn about? That was kind of my starter point. So for everybody that's a little bit hesitant, that's maybe one of those things.
So, right. So on a side note, and it might be a slightly advanced, but that's okay. Are those? So do they have? What's the word? So there's 41 of those, right? And I'm assuming that the insured are key employees, I'm guessing, and then the beneficiary is Wells Fargo. So in essence, when those folks die, they all the benefit goes back to Wells Fargo.
100%.
Which means a company like that, in theory, over time, really should never dissolve, because it'll just keep rejuvenating.
Yes. And people say, well, what do they do with that money? They provide corporate benefits. One of the most recent cases that got publicity was a couple of years ago when it came out that Jim Harbaugh, when he was still at Michigan,
I remember that,
was receiving his money through a life insurance contract. And so that what they had done is that they were lending him the money, right, as a loan. And in essence, he had to take that money and put it in a life insurance contract, which then they were a recipient of part of the beneficiary of that. So then they recouped 100% of what they had paid him when he died.
Sorry, go ahead.
So how much does it cost them?
The company, nothing.
Yeah, it cost them zero. They provided.
They were paying the premiums, right, on his behalf. Gave him the policy loans. He got the premium. Yeah, I mean, it's a very smart avenue to do it.
He recouped 100% of that process. So, if it makes sense at big levels, then just take it down to the you and me level. It starts to make sense. Now,
let's So I get most of this. Obviously, you get most of this. I'm trying to this component we're talking about. Stay here with me for a second. I want to explain, or have you explain exactly kind of how this can be. And really what it is you're taking these policy loans, right? So you're taking that money and you can choose to pay them back or not pay them back, right? Because the bank is collateralizing your cash value. But in essence, keep in mind, upon death, the bank, or not the bank, the mutual company owes you the death benefit. And if you have outstanding policy loans, in essence, it'll just deduct that from the death benefit. So that's how that in essence happens, that at some point they're going to get that money back. And obviously you want to pay your policy loans, because if not, it's going to negatively compound and accrue. And in essence, your death benefit might not be anything if it negatively compounds. But that's their collateral is the cash value. And, but even if it's never paid back or whatever, it's coming out of the death benefit. Is that correct?
Correct. Right.
Okay.
A policy loan, an insurance policy loan, is technically a prepayment of the death benefit.
Okay.
And for 99.9999% of the population, they never anticipated personally being able to use their death benefit, right? That was something that's left behind after we die. But yet every one of us who has a permanent life insurance policy where we've taken a loan against that cash value, we are in essence using the death benefit while we're alive, which that's pretty good. That part of it makes sense now that we would call it life insurance instead of death insurance. But going to your point, let's visualize this for those who are watching on YouTube. The second component of this is the leverage. So like, actually, how does this work, right? Because for a person who's never taken a loan against a life insurance policy, it's a foreign concept. They've owned life insurance. Most of it's been term insurance. So there's not a cash value. And even for people who have cash value life insurance policies, a lot of them have never taken a loan. So they don't even understand how it would work. So I'm going to try to walk you through the basics of this. So if I'm taking a loan, I'm not taking a loan from my cash value. I'm not physically putting my hand in there and reducing the value. So if I had $150,000 in my cash value and I wanted a $100,000 loan, I'm not reducing my cash value from 150 to 50. I am taking a loan from the insurance company itself. Then I can use it to go buy real estate or lend against real estate. And how do they do that? A couple of things. One, they're going to make it an interest-only term, which is a huge benefit to me, right? Because having some sort of amortization would put a lot of pressure on any deal I do, always having to work immediately, very fast. Secondly, it's going to be unstructured, meaning that I don't have to make a monthly repayment. I don't even have to make an annual repayment. I like what you said earlier. We want to make sure we are repaying, right? Because if we're not repaying, there's a good chance that that'll build up against us, but I'm not forced to. So it gives me flexibility in the deals that I'm doing. So the insurance company, all they're going to do is take a $100,000 loan against my $150,000 cash value. They're just going to put a lien. And we all know that. Like if we have real estate, we've ever taken a home equity line of credit, they just put a lien against the value. Now, they're not going to give you a home equity line of credit on your house greater than what your house is worth. Well, the insurance company won't give you a loan against your cash value then greater what your cash value is. That's very similar. So the two components, if you've ever taken a home equity line of credit, you already get it. The difference is that our house values can go down in value. And in a house loan, I'm going to have to have, the appraisal. I'm going to have some probably fees along with there. I'm going to have to, validate that I can repay it. I'm going to have to, have my credit pulled, all of those things. Well, the insurance company, they ask two questions. How much do you want? And where do you want us to send it? There is no credit check. So the question that people always ask me when we talk about using life insurance, and it was the question I had to get over because I was a cash guy, right? I wouldn't say I was a Dave Ramsey guy because I still didn't believe with some of his philosophy, but I was definitely a cash guy. Isn't it just cheaper to use cash than borrowing, right? Like it just makes sense. Like if I have any expense for using money and I have no expense over here, I've got to be ahead by using cash. And it wasn't until somebody shared this basic philosophy with me, and that it was something that I hadn't really grasped. They said, Russ, when you build up cash in an account, and let's just use that example we had a second ago, I'm building up cash into my, $150,000, and now I have enough to go do my private loan or buy real estate, whatever I'm going to do. And I take that money and I go do the deal. Now my cash account goes to zero. that money that was in that account, even if it was only earning 0.5%, no longer can be earning for me. And so I repeat this process over and over again, thinking I'm getting ahead, but I'm really just getting back to zero when it relates to that specific thing. So for those of you watching, this is going to make a lot of sense. You're going to probably have one of those brown bag moments where you're going to need one. And here's what it is, Jason. I don't know if you've seen this before. Have you seen an example like this before? Showing kind of the cost of using cash?
I don't know.
All right. Well, everybody, if you're listening, let's see if we get Jason hyperventilating here. So this is the base example. I share this all the time because depending on what business people are in, I say, let's just pretend for simplicity, we're going to put 25,000 in our business and we're going to earn 20% over time, right? 25 years, we're going to earn 20% on our business. And for every business owner I deal with, they'd say, Russ, that's not enough to get me out of bed. And I go, I know. But we got a lot of new people out here listening, and they think 20% is like way more than they could ever get to, right? So, but for simplicity, if 25K earned 20% of the business, never was touched over 25 years, it grows to 2.3 million. You validate that for everybody just listening and not watching?
Yep.
All right. Now, here's the one thing. Cash is expensive. So if we go in and we pull our cash out, so in year 5 here, I'm showing taking a $20,000 withdrawal. Just pretend you're going on a nice vacation this summer with that 20 grand.
Yep.
And I scroll down and I look at how much money's in my business in 25 years. What's that number down to from 2.4 to what?
1.4.
So that's a $920,000 difference for one $20,000 withdrawal. That's crazy.
Yep.
When I say cash is the most expensive thing, this is what I referred to, because this opportunity cost, everybody's probably heard to some degree this idea of opportunity cost, but we don't get a receipt for that. Nobody sends us a bill in the mail that says, hey, by the way, that $20,000 expense that you took when you took that withdrawal of that account that no longer was in your business, that just cost you $920 over the next 25 years. Nobody does that. We would be like, wait a second. It cost me $920. What if could I borrow the money from Chase Manhattan? Like, what can I do to reduce that $920,000 expense? It's a dramatic visual for us to realize that cash is expensive. When we use cash, it's expensive. And you start thinking about this in the number of transactions that we do, it's like, oh, crap. Well, if I could have leveraged this cash, right, then wouldn't my cash continue to have grown uninterrupted? So that 20%, let's just pretend the business would have grown to 2.4 million. But if I could have borrowed that 20 grand from somewhere and had to repay it, would I have been in a better or worse situation than having pulled it out and not have the growth at all? So that's what uninterrupted compounding. So if you ever listen to people talk about infinite banking, definitely if you're listening to our podcast, we're always harping on this because this is the visual that we all need to have when we use cash. It's not that I want to go in debt, that I want to borrow money externally all the time. I want to have control over that. But what if I'm controlling it by using the life insurance contract, right? If I have cash, my cash has been substituted now for cash value. So I have all the safety that the warm and fuzzy feeling. Most of us wake up in the morning, we open up our Facebook app, our Instagram app, but most of us also go to our checking accounts. just warm and fuzzy, just making sure it's still there, right? Well, if your cash was in your cash value, you're like, hey, this feels pretty good. Especially if you start to think about these insurance companies have been around for 200 years, and the bank that you're using has probably been around 50 years, maybe 100 years tops if you're using one of the top 2 or 3 banks out there. And you're like, oh, I feel a little bit better about that, right? So now I get uninterrupted compounding when I'm doing the real estate deals. Any questions on that before I move on to the next part?
No, go ahead.
Is this helpful, by the way? Do you feel like this is like...
I think these are good charts and are good real life examples.
All right. So I want to talk about the third component. So we talked about how to redirect it, make sure we get it out of places that we can't touch. How do we leverage it? Why do we leverage it? But then let's talk about recycling, because this is the part that really kind of getting into action, and we'll lead this into a case study, is that if I go to the insurance company, I take a loan, they send that money to me. Remember, it's an interest-only loan. It's non-structured, right? I get to pay it back on my terms, not theirs. It's a prepayment of the death benefit. They give me that money. I decide what I want to do with it. So in our world right here, we're talking about taking a loan and lending it to somebody against probably a piece of real estate. They're going to pay us cash flow back as a return on that money, right? When that money comes back to us, let's just use 10%. We gave them 100 grand. They're giving us that 833.33 a month. We can either A, send that money back to the insurance company, and all that would do is reduce the lien against our cash value, meaning immediately give us access to it, right? This is a side point. One of the reasons I don't like using lines of credit against homes and stuff is that the banks have the ability to freeze those lines, right? Because I saw that. I've been around this world for a long time doing this stuff. And in 2008, 2009, 2010, I saw a lot of lines of credit get frozen. I mean, business lines of credit, home lines of credit, people that were running substantial businesses and investments out of it. When those lines went down, they went bankrupt. So I'm very conscious of that. So not that I don't use them, but I'm conscious of the fact that they can always take them away. But what I love about all of my life insurance, basically quote unquote lines of credit, is that they don't take it away. That's a privilege given to me in my contract. They're contractually obligated to give it to me. So when I repay with no fear of paying that money back and not being able to get it back. So whenever I have money coming to me, I can A, send it back to the insurance company and reduce the lien, giving me access to the money. And that's probably the best thing if I have nothing to do with it. But if you're in the world of having something to do with it, then I'm just going to recycle it. I'm going to take that cash flow I got and go do another private loan if I can, right? So now I have two things coming back to me. I have that cash flow from property one, property two, whatever it is. And I can use that money to either recycle it, do another deal, or send it back to the insurance company. Always have those options. And people are always asking me, hey, Russ, I just got this lump sum. I just had this deal pay off. What should I do with it? Well, do you have a policy loan big enough to hold it? Yes. Do that first. Just pay it back. Because now you can start thinking about what do you want to do with it? You have the options. You can choose. That's the best position to be in, is to have options. What people do, though, when that cash comes back, and I know that you and your business partner are so good at this, and I was bragging on you guys earlier today on our podcast about seeing 100 deals and only doing one. So many people, though, get in that see deal, do deal mentality because they have the fear. I've got this cash and I know it's costly. I got to put it back to work. And they end up doing a bad deal because they're fearful of the cash sitting idle, as compared to if they had a safe place that was going to earn them some return. Then they could say, okay, I can wait. I can see some more deals before I actually put that money to work in a safe place because they feel comfortable.
And I'm assuming it makes the most sense. So let's just put yourself in a private lender's world right now, and they do a 1-year loan. They're getting a 10% return. Doesn't matter. They get a 15, 20% return, whatever. That's irrelevant. I guess it makes the most sense as monthly payments are coming back to them from the borrower to just pay the minimum interest to the policy, not the principal as well. If you can keep that money working for you, so you can keep your compound going, right? Because let's say the policy loan's 5%, you're getting 10%. You're right. You're making that 5% arbitrage, that spread. You want to keep that you want to keep that kind of, let's say you're in a fund or whatever, and then you can keep redeploy it and then redeploy it, then redeploy it and redeploy it. That makes more sense, right? Than to pay the principal down anyways, right?
If you have the ability to redeploy. So not all scenarios, right? There's some funds that require you to meet their minimums before they allow you to reinvest, right? They may say, hey, we're not going to let you reinvest into the fund until you get our minimum again. So like in this situation, they're getting 10 grand a year. Hey, we need 25K before we let you redeploy. So once you build up 25K, then we'll let you come back into the fund. So what do most people do? That 10K the first year, 10K the second year, the first 5 of the third year, where does it go? It just sits in a checking account. And so it's literally not do anything for them. And so what we would say is that's one of the biggest reasons why we advocate, we're advocates for infinite banking, is that our cash sitting idle. One, we're not going to always use all our cash, right? Because we're always sitting some portion of money away for emergency reserve, OPEX stuff on different businesses and investments. We're always holding cash to some level. So we need a good place for it to sit. But also, even our investment capital, we can't always redeploy it immediately. There may be some limitations to how quickly can we get it back out there.
Got it.
So the key is that the most common thing that I had, I hear as well is that doesn't it take a long time to build up cash value? You and I have had a conversation about this. And there's a couple things. One, I would say if you're listening to our podcast, you can hear hundreds and hundreds of interviews we've done with clients who talk about all the deals that they've done, right? And they will tell you, we have people who take a loan within 7 to 10 business days of starting their insurance policy sometimes. Now, we do have to tell the insurance company, no, they're not money laundering, right? We have to make sure that they know that they weren't doing that, because that's a fear of insurance companies if they see loans immediately. So we have to get over that a handful of times with people. But yes, they're using that cash value. And the reason why the cash value doesn't take a long time to build up the way that we do it is that we're not focused on the death benefit. This is what we've been sold by all the life insurance agents out there in our life, right? I'm not saying anything bad about them. Man, I'm grateful for so many of them. So people wouldn't have life insurance if they didn't have the Northwestern and State Farm reps and all those people in their life that, call them and hit them up, for that stuff. But I'm not referencing that. This is not that world. I'm talking about literally buying dividend paying whole life insurance to build up cash value. So what we do is we minimize the death benefit and we maximize the cash value. And by doing that, I get that cash value build up way quicker, where it may have taken 20 years in the old days, right? In the old way that insurance policies were designed. But to what you and I were talking, I have cash value immediately in the first year that I could borrow against and put it at work. And so that would be, if we want to look at a case study or something, that's the mindset I'm going to look at, is building up cash value as fast as we possibly can so that we can then put it to work when it makes sense.
Yeah, no. And again, you're right, because if you do this in day one, because what I'm trying to think on mine, I put in 50 and I had cash value of like 38 the first year. And like that, and that's a limited belief, including myself, that I've had before, of like, hey, well, if I had 50 grand, I just put into a hard money loan, I'd have all that 50 grand right now.
Yeah.
But I only could put 35,000 into a hard money loan. Right. Plus the other, and then over time, I'm 4 years in, right? So I'm almost at that point that it's a dollar in, dollar out of together. And that's going to be a powerful thing. And then it goes from there, because I saw a chart, and I think I still have this. I literally still have this on my computer that I screenshotted when we talked months ago, from one of your policies that you started in 2011. And I'm looking on it on my other screen right now. And you had 25,000 in year one, and you only had access to 17. It looks like you did 25,000 for 5 years, and then you started doing 7,500 starting in 2016. And then, so that was the 6th year you put in $7,500, and you immediately had access to 12,500.
Yeah. That's the so what to it, right? Like people that ask me questions about the startup, I say, hey, there's a trade-off in years 1, 2, and 3, probably maybe years 4 and 5, depending on the situation, where I'm going to trade off some liquidity, and in exchange, I'm going to get some of those benefits that maybe right now I'm not so interested in, but I'm happy with down the road, right? The death benefit that comes along with it. But I'm also knowing that I'm not using, in your situation, you weren't using your last 50 grand, right? Like that you were deploying excess cash. So you probably didn't need that 50 grand available that very second, because you had plenty of deals that you were doing. So for most people, the gap between the 38 and 50, that 12,000 your situation, that wasn't a deal killer for you. Like it's not going to be the difference of you eating. But what will change is, like what you were sharing with my personal experience, is that once we get past that point of equilibrium, we start to see when I put $1 into the account is growing that year greater than what I put in it, which is never the case in our checking accounts, right? We're always using checking accounts for cash. So when I get to that point, I'm going to make up those years early on that I was behind really fast. And when I get past it from that point forward, when would you ever want me to stop giving you $1.50 or $2 for every dollar you put in my account? The answer would be never. When would you have wished you would have started it? As far back as you could think, right? And so most people, they say, oh, okay, so I'm okay trading off early on a little bit of liquidity to get some death benefit or whatever, these auxiliary benefits. But ultimately, what I want is to get to the point where $1 in equals more than $1. And then that means I could do more private loans, more deals, more cash flow, which gets me to passive income greater than monthly expenses faster.
Yep, exactly. And one of the things that I looked at when I got mine was, even though I was going to continue to make premiums and stuff, it was like, when is this thing kind of self-contained and it in essence can grow without me putting any additional funds into it? That was kind of the way I looked at it. And that, I'm not saying is the right way to do it. That was just, for some reason, the way I was looking at it was, when does my cost, call it premiums, when is that self-absorbed? I don't even know if I'm using the right word. I'm just making up words here. I'm talking. And when does my paid up additions cover themselves?
Yeah.
And that was it. And that was, that was just something that I looked at, because I've always looked at this as, does it make more sense for me to take that $50,000 and to put them into my hard money loans, or do it this way? And that's also why I think I heard you say something that, like, typically a lot of folks either fully get it or they don't get it at all. And I've always been in the middle of, like, I'm comfortable to put $50,000 into this every year. That's where I wanted to start. And, if I got to a place where it's like, I need to put every last penny in, then I'll just keep adding more policies.
Yeah. Well, here's the key is that, man, learning is just a movement in the right direction, right? So everybody's on this journey differently. I'm sometimes even frustrated when I see people get it so fast. And I'll tell the story and then I'll share a case study if we still have time. But I heard the concept of infinite banking in January of 2005 for the very first time. And it wasn't until January of 2009, after hearing it 5 different times over a period of that was 4 years, that it really started to click and set in. And it still took me another 6 months of just, okay, I got to whiteboard this out. I got to get the yellow pad and like really do the math. And so it took me 4.5 years from the time I heard it first time to actually starting in my first insurance policy. I shared this concept. I shared that book, Become Your Own Banker, with 3 of my best friends and business clients that I had. And every single one of them came back and said, oh, this makes total sense. Why didn't you tell me about this years ago? Let's go ahead and start putting $100,000 a piece in. And I'm like, are you kidding me? Like, I was expecting you to ask me all these questions and like be as frustrated as I was. And you're like, you get it? So when I see people who get it right away, I'm like, pissed, because it took me so long. But I think it's probably all that professional training I had that I had to unlearn as compared to not. So for those of you watching, this is going to make probably a lot more sense than those who are listening. I want to share an example here, and it's, I think, worth us going through, because I'm going to share with Jason how my insurance policy at the end of year 1 is going to have 38% more cash in doing one deal than his. And if I look at it over a 30-year period of time, which is, by the way, a fraction of the time the 2 of us hopefully is going to be on this earth, it's going to be 191% more doing it this way as compared to the other way. And so here's the math. Let's just pretend I have 150,000. I'm willing to use $100,000 to do a private loan with. We're going to use basic terms at 10% return. I'm going to say we're in a 30% bracket, which neither one of us are. We're probably much greater than that, but that's just the simple math for people listening. I'm going to use a loan rate at the insurance company of 5.5%. I'm evaluating over that 30-year period of time. So the simple way to follow this is that $100,000 in cash, right? Jason's doing a cash deal. Let's pretend he's doing a cash deal. He earns his 10%. Everybody doing math at home says Jason has $10,000 at the end of the year, right? Wrong, right? Because Jason's going to have to report that $10,000. And if he's in a 30% bracket, he's get $3,000 taken out of his pocket. So he nets $7,000. Makes sense? So if Jason kept doing that deal every single year for 30 years, his 7,000 times 30 would be 210. He had 150,000 in his account to start off with. He's got 360 at the end. That's just basic things. Now, Jason could have been rolling and compounding, so forth and so on over time. But for simplicity, let's don't confuse the numbers. Let's keep it as it is. As compared to me, I've got 150,000 not in checking, but in my cash value. My cash value is earning 4%. So at the end of the year, I'm going to have $6,000 as a result of my $150,000 earning 4%. Now, I'm going to take $100,000. I'm going to take a policy loan. Remember, at 5.5%, I'm going to do a deal, the same deal, earning 10%. So I got 10,000. I'm going to have 6,000 that my policy grew. So now I got 16,000. You're like, oh, I like that. But yet I'm going to also have to pay interest to the insurance company, and my interest, because I'm going to be paying back as those payments are coming in, those $833.33. In this example, I'm just showing that I paid it back as it was coming in. So instead of having a $5,500 interest expense, I reduced it a little bit by making interest payments along the way. So my net expense was $4,789. Now, I too have to pay taxes. The difference is, though, I get to deduct the interest that I incurred in order to do this deal. That's called investment interest expense. I'm not an accountant, so make sure you talk to your accountant, but all my accountants tell me, Russ, you can deduct your investment interest income against your investment interest expense. So my taxable amount of this, Jason, is the 10,000 minus what I paid in interest, right? To the insurance company. So I pay tax on not on 10 grand, but on 5,200. So my tax bill was half of what yours is. So that's one uptick. You're like, oh, I like that. Like the government getting less, right? Yep. They don't tax me though on that 6 grand. Why do they not tax me on the 6 grand that I earn inside the insurance company?
Because it's tax free. All your earnings
right.
From that policy. And let me ask you a real quick question on that. And I'm pretty sure I know the answer, but I think people can be like, well, how's that possible? It's just because the money that's coming to you is repayment technically of principal. It's not necessarily interest. That's just the way that it's categorized, right?
So there's a subsection in the IRS code 7702 that talks about exactly how life insurance contracts are taxed or not taxed. And this goes back, these insurance companies have been around 200 years. The tax code only been around not even 112 years now, 1913. So they predate all of that. But ultimately, the way Congress looks at it is that they do not want to be in the business of having to provide death benefits to the population. So they're going to extend certain benefits to life insurance companies that, one, the tax, there would not be any tax, a federal tax on the death benefit. Now, there is inheritance tax because it can fall into that, but also the internal growth in the insurance policy, they're declaring not taxable. So for most of us who never use a life insurance policy, but understand, say, like how a Roth IRA works, I get growth inside of it without having any tax. That's exactly what's happened inside an insurance company. My 6 grand for that year is not taxable. So I'm adding that 6,000 less what I have to pay in interest to the insurance company, less what I'm having to pay to the IRS. So 10,000 plus 16,000 minus what I paid the IRS, which is 1,500, less what I paid the insurance company was 4,700. I net 9,647. So if I compare that to Jason's just pure simple cash deal, which is much easier to look at, I've got 38% more than he does. I've got 9,600 and some change. He's got 7 grand. So if the two of us were doing private lending side by side from this point forward, who do you think is going to win? Assuming I had the same IQ as he does, which I don't in private lending, right? Like he's going to swamp me when it comes to that. But assuming I could get him to invest my money right alongside of his, I would have more money. And now if I take that out to 30 years, right? I take the same deal. What does my 150 grow into? Earning 4% over 30 years, it grows to, 486. What is the 9647 every single year? If I did that for 30 years, 562, I end up with about $1 million, which is about 190% greater than the 360. So when we start looking at how do we, make strides in infinite banking, it's by just using the basics. Like really, I'm comparing your checking account to my insurance policy. I'm using your creditor protection versus mine. And what we didn't show on this, which is kind of the byproduct, Jason, is the death benefit, right? If I was doing this deal and you've obviously put $50,000 a year into an insurance policy, ballpark, what's your death benefit on that 50,000?
At the end or now?
Well, right now, and then also probably what I don't know if you've looked that far at the end, but
I mean, it's over $1 million, obviously now. So like in essence, I put 50 grand in and I'll have $1 million.
Right.
I won't have $1 million, but beneficiaries will have $1 million. But I want to say 20 mil, 36 mil. I don't really remember.
So that number, right? Like, so there is a comparing the two at the very beginning. But then there's also this comparison at the end. and we're playing the long game. At least I think most of us are. We're playing the long game. There's a reason why we're doing this, and so early on, the difference is for Jason. You've started this, and you can start using your contract to do the same thing I am. There's someone listening though. It's like, well, I have to start this. I'm going to start behind. I'm not going to have all of that cash necessarily to do it, which is true, but it's okay. You're a little bit behind early on, but in the end, you win big time, right? Like you see like the results of this is that doing every deal is going to help you get ahead. Your return is going to be greater, but then also there's going to be this ridiculous death benefit that's going to trump everything that we've done. And going back to what we're talking about with Michigan, with Jim Harbaugh and the banks with, using it for their cash value on the books that we were showing a second ago, like now every generation after us, if they're implementing this concept and using the windfalls that come from the death benefits, like this is why the Rockefeller family is still one of the most wealthy families in the world, hundreds of years after the fact, is because they have a trust built where every family member has this life insurance put on their life, and the death benefit is the beneficiary is the trust. And so all of those inheritances, just like Harbaugh was getting paid from Michigan, that's exactly the way these beneficiaries, these trustees, not trustees, but the beneficiaries of the trust of the Rockefeller family are receiving money, but it's as a result, they have a death benefit. And so the trust receives back all the money, and they just keep recycling it and doing it over and over again.
Yeah, that was one of the things that sold me a lot. And if somebody searches that up or researches that, I mean, that's very interesting because you hear, endless YouTube videos of people talking about that concept. And it makes a lot of sense because, whatever, let's say you have, think about it, let's say you're a parent, you got 3 kids and you have these policies set up for each individual kid, and, 2 kids are responsible and, use it. They buy a house, they buy a car, they invest with it, and everything works out fine. And then you have a 3rd kid, maybe they're black sheep of the family, and they can do whatever they want, right? Here's the money that you have. You have full access to it. Well, guess what? It all gets replenished upon death, and it goes back into the trust. And that's why a family like that, they can't lose, right? Because, it doesn't change. The death benefit replenishes a lot of it or most of it. So they're never going to go they're never going to go in the wrong direction. One of the things, Russ, I was thinking about is definitely want to get you in here to if it's okay with you, and maybe we'll do something for our Hard Money Mastermind group. I know we try to keep this 101 a little bit broad, although you did go into some really good detail on this. But I think if you kind of came on to maybe one of our Hard Money Mastermind coaching calls, people could ask some questions if that's okay with you. I think that would, because I'm sure people have tons of questions. And one of the things I was thinking about as you were talking in that last chart and that last graph that potentially could help benefit some of these folks is maybe even comparing the two with compound interest. So like doing a private loan, and then let's just say you compounded it. So, 100,000 is 110 at the end of the year. Okay, now I got 110. I'm never going to take that money out. Where does that equal down the road? Compared to infinite banking. And if it works one way, it works both ways, obviously, because infinite banking would be compounding with, the money that you're using to arbitrage, or you're playing the arbitrage game on. So your policy loan money, I should say. So I think that's good. I'm looking through my list of questions, and one thing I'm not sure that you stated, but I think it's an important thing that I had that aha moment with was when you're investing into a private note and then you reinvest it and it's compounding, right? You're getting compound interest on that, right? You have 100, then you have 110, or you're lending out at 15%, 115, and then you start with that. That money's growing through compound interest, but your policy loan, you're repaying in simple interest. And if you actually look at that formula, and I did it on one of my whiteboards back here that you can't really see, but that makes a humongous difference because they think it's like, hey, well, I'm lending out at 10, I'm getting 5, I'm borrowing at 5, I'm only getting like a 5% difference but it's significantly more than that because that money's growing at compound interest upwards and you're paying it back a simple interest downwards.
Yeah.
Is that a correct statement?
No, you're totally getting it. And that's like, and for those, most people, right, are going to have some level of cash always sitting, and I always talk about that. And we can look at the part that we're deploying, but the key around this is that knowing that we're going to put ourselves in the best position by building safety nets around us. And I think as investors, we need that. We need more safety nets, right? We can't go. I heard you say this on our podcast that you and your business partner crush singles on a regular basis. Every once in a while, you hit some doubles. You're never trying to hit triples and home runs. Like that's a bad situation for you because you've gotten outside of your lane. I tell people infinite banking is really just a replication of doing that very thing. We need a safe place for our cash. And when opportunities arise and we have those and they're going to people like yourself and learning how to do these deals, it only will accentuate, improve what you're already doing. But what it'll do is also protect your downside. It will help you find places, because Nelson Nash was a big component of saying, when you take a loan, you have to consider that you have a loan from a bank and that you have to repay that loan. And if you're not repaying that loan, then you're still in the P's. He gave an example of the grocery store and the grocery owner owning the grocery store and the wife wanting to take groceries out the back door instead of pay for them or at the front door, right? So you have to consider that every time you're doing this. And if you do that, what you're doing is building safety around everything that you're doing. And that's what I've learned of doing this over 15 years is that the people who do stuff like you guys are doing it the right way, staying in your lane, using as many contingency plans around it, building margins of safety in how you do it. It's only going to help you be that much more successful. This isn't get rich quick. This isn't some money scheme. As you can see, I started off with the bank to let you know banks don't do bad deals. They're going to make sure they do good deals. There's a reason why they have almost $20 billion in cash value. It's a good deal. And so for us, we need to think that same way. Think safe and figure out how it can help us continue to grow our wealth, grow our cash flows, and do all of it in a safe way.
Yeah. No, this has been great. No, this has been great. I'm hoping everybody that listen to Russ or watch Russ got some value out of this. This has been a topic that's a hot topic around our office all the time. I was literally just talking to my business partner Chris about it because at this point he doesn't have a policy set up, and I wish with 100% certainty I can explain to him some of the questions, but like or some of the questions that he has, and he gets it. He gets it more than a lot of people, and still. So I thought this was great, and I think that most of the members of our group, they want to, they want to make smart investing decisions, but they're sophisticated and they want to, if they can get an edge up on something, they're going to, right? Yeah. And I would say that the majority of the folks, including myself, is if I have a few $100,000, millions of dollars, do I invest that with cash? I have it in cash, I have whatever, another investment account. Do I invest that in cash or do I put it into one of these policies? And I think, you made that clear that it makes sense to, go through this IBC. So, that's great. And hopefully we can invite you onto our Hard Money Mastermind group call here in the very near future. So folks can ask questions. One of the prerequisites is I'm going to make sure they listen or watch this podcast first, just so when we do it, it'll be a little bit more advanced and not some of the one-on-one stuff. But no, this is great. I appreciate it.
No, love it. And definitely, if you want more details, go to that wealthwatchwallstreet.com/private lenders. And we got all sort of resources on there. I'm sure there's probably a free call link that one of our coaches can walk through. And make sure you mention, like if you actually do get on a call with one of our coaches, make sure you tell them that you heard this on the Private Lenders podcast, because I'm going to tell them if you guys decide to go through a setup with us that we give a significant discount to your listener, because I want to add value to them. And I'll make sure we throw in a bunch of bonuses and stuff like that. So it's like a complete no-brainer for the people who want to go further. Yeah,
this has been great. Okay, so if anyone's listening or watching, make sure to check out wealthwithoutwallstreet.com/private lenders. I'll make sure the link is in the description as well. And Russ, thanks again. I really appreciate it.
Thank you, man.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note, that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.